Hello, comrades. Commissar Bro here today with week 3 of the business strategy game. That's right. This is year 12, projecting for year 13. Yeah, I always get a little confused with those numbers, but the important thing to remember is this is week 3. So, with week 3 starting right off the bat with the scoreboard, you can see that DCB Shoes has managed to dominate the competition. That's right, our overall score being 109. And technically, our game to date score is 110 with one additional bonus point. We actually got the Bullseye Award for being really damn close to projecting the right amount of performance we ended up performing at. Now, I will admit I was not so optimistic as to assume that we were going to exceed and make the expectations that we were setting for our performance, but we absolutely did, barely missing it. Our best in industry score is 99, and the investor expectation score is 119. So we are doing phenomenally. Going into a bit more detail, our earnings per share is going to be $7.18. That's right, $7.18 is the earnings per share, giving us a solid lead over our opponents and a huge jump in earnings per share from the week prior, or the year prior anyway. So we went from 451 in the second week there to 718, and we completely trounced our closest competitor, who's at 570, whereas before we were neck and neck. I mean, it was very close. He was barely beating us, but we managed to jump past him, giving us a huge lead over everyone else, but still being within reasonable limits of Company C. Company C can still very much come back and make a huge comeback in earnings per share. Return on equity, again, we saw a huge jump. A 5% increase on return on equity. Already we were at a pretty solid number, but our return on equity right now is almost 31%. That's phenomenal. Again, we are leading the pack with the closest being 5.8% behind us. The weighted average right now for so far being 28.7, still a huge jump for us. And the most phenomenal increase, in my opinion, is our stock price. I mean, we went from $30 at the very beginning to $77 to $148 a share. That's wonderful. Like, truly, to give you a comparison, Adidas stock, just looking it up, is only 150 euro. Nike stock is going to be, let's see, $56.45. So basically, our stock per share, it's big. It's pretty big, my friends. It's pretty big. So we are a very valuable company, only on our on the 12th year. But as we can see, all of our opponents have increased. We just had the most monumental jump. However, Company F has started to make some major changes in their company, and we're starting to see a huge increase on Company F as well. That's basically the person that we want to keep our eyes on as well, aside from Company C, because if they continue to do what they're doing, this could be very dangerous for us going into year 13. So this is our big changes there. Taking a look at credit rating and image and so on. Our credit rating for year 11 dropped down to a B+, but by year 12, we've got it back to an A, being one of the highest, or being the second highest, or if not the highest, including Company C. So that's another huge improvement for us. And then if we go down to image rating, once again, absolutely boosted our numbers. Our image rating being a solid 98 out of 100. Pretty much showing us as being a huge competitor here. Being pretty much having the best image by far. So this has a huge effect on why we're doing so successfully currently. And then corporate social responsibility and citizenship, not all that important to note, but what is important to note is that we generated 8 points from it. That's the best thing to note from it. We generated 8 points. So if we weren't doing what we were doing, minus 8 out of that, we'd only be getting about 90. So it's, as you can see, putting what we're putting into corporate social responsibility and citizenship is a huge plus for us. Going down to bonus points, again, we can see that our year 12 forecast and our year 12 actual was within a 2.3% variance, which is really damn close. I mean, we almost called it head on the nail. And even then, our year 12 forecast for earnings per share and the year 12 actual, once again, really close, 4.6%, within 5%, really damn close. And then our image rating, we called it. I mean, we got it, 98 exactly. So we basically got an additional point for that for getting bullseye. So good job there on us. Going into a little bit more in-depth information, if we wanted to look at the overview and our plant capacity and how we performed, how many pairs were rejected, and so on and so forth. Overall, we did a phenomenal job. I mean, absolutely phenomenal job. We're still the only person out of all the other companies. This is basically everyone, adding everyone in, but we're still the only company that really has any production in Europe, Africa region. There is, and this is including our overtime and whatnot. So we did a phenomenal job there. We overutilized our capacity. Look at that, 120%. To give us what we needed to produce. I mean, this is the demand in the region, so there's absolutely no reason we should ignore it. There's a huge demand for branded shoes, and as such, we move to actually meet that demand. If we're looking at the increase in footwear demand, potential global demand is going to be at 45,000 or 45 million pairs of shoes. So with that in mind, it still benefits us having a larger share of the market than our opponents to actually want to increase capacity. And that's something we'll go into in the future when we get there. Financial summary, going into additional data. You can see here that we utilize the most of our cash. Our total assets are huge. We made our money back. And I mean, we've got a lot of debt to pay off, but we're earning so much in profits that it honestly doesn't matter. Like, as far as I'm concerned, I'm making so much profit off of how I'm performing that I'm happy. I'm happy with it, and we just got to pay off our debt, and bam, like, we're making an additional $50 million a year in profit to go on top of the $60+ million in profit we already made. I mean, if we look at earnings retained, so this is pretty much the best way to look at how much profit you made. We made $71 million in profit. Now, assuming right now, if we did not grow and the market did not change, if you pay off the debt this turn, you're going to be making $120 million in profit. Just pure effing profit, baby. So that's absolutely wonderful as far as I'm concerned. I'm pretty excited about that. And what we're basically going to turn those additional profits into is we're probably going to start buying back stock to increase our stock price. Because why not, man? We're making so much money at that point. But again, it's important not to get too comfortable and assume that our position cannot be dislodged. It's also important that we should probably start paying dividends back to the shareholders to continually improve our position in the stock market. Performance benchmarks, again, this is going into a little bit more detail. We don't really need to as far as I'm concerned. It's basically just showing us how we compare to our opponents in terms of how much our shoes cost to create and what the average is out of all these regions. As you can see, we're below the average. We are beating it on that level. Marketing expense-wise, we're below the average. Operating internet profit, we are operating internet profit. Technically, our profit is below on the internet, but we own a dominant share. So with that in mind, we could actually increase the price and no big deal. As far as I'm concerned, the more market share we have, nudging other people out of those markets or decreasing that, makes them have to adhere to our strategy, which means that they're going to have to lower their prices to meet us. So as far as I'm concerned, I'm operating in competitive pricing. I'm making them change how they are operating to compete with me. I'm not competing with them, they're competing with me. And that's kind of what I'm shooting for, and I believe that is showing that. Because again, this was all from year 11, and if we look at the change into year 12, you can basically see in a certain number of areas we are over the average, but it's where it matters most. and the average that we're over, we're still not the highest. So we're not paying the most, which we could be, but we're still making the most profit based on the cost that we are paying off. So, I mean, it's really not that big of a deal as far as I'm concerned. And what's still very important to me to look at is looking at the averages of manufacturing overall. We're producing the most shoes, we're making the most money, but we are still below the average in manufacturing costs compared to our opponents. We're doing something right, as far as I'm concerned. So that's where that's important, and that's where these operating benchmarks ultimately are very important in how we're looking and seeing how we're dealing with our opponents. So yeah, I'm pretty happy with most of these numbers. Celebrities and price trends, going into a bit more detail again with celebrities. You can see that we pretty much own the most of the best celebrities in the market. We've got Michelle Wie, we've got Jose Montana, Cristiano Romano, and Oprah, Beyonce. And F Fearless Footwear seems to be the only other person competing for celebrity endorsements, has Peyton Manning and Tiger Green. Tiger Green being someone I actually would have liked to have, but it's not that big of a deal as far as I'm concerned. We have more than enough celebrities to really kind of secure our position in this respect. And we did bid against other people for Michelle Wie and Jose Montana, but we basically said we want them more than what the other person wanted them for, so we upped the bid and won the contract. But we are still winning these contracts at astronomically low prices. So with that in mind, I don't mind at all signing these people who are going to sell me millions of pairs of shoes for basically just a couple $1,000,000. This is worth it. Absolutely worth it. And as you can see, I could actually go ahead and try to sign for a few other people if we went that route. So let's go up a little bit and take a look at some other data. We could look at Market Snapshot. This is one of the most important things to note. It does say what our competitive strengths and weaknesses are based on the internet segment and the wholesale segment. So that's something we'll go over real quick, and then I'll show you basically projections for next year, and we'll call it a day. So our competitive strengths in the internet segment is our price, our SQ rating, our advertising, and celebrity appeal. The only weaknesses we have is we don't offer free shipping anymore, and the models that we offered are limited. However, the way that I look at it, I don't mind that, actually. I really don't mind that. And I say this because, quite simply, I don't mind not offering free shipping anymore. We did that in the first week. Now, it was important to me at that time to gather the needed market share to basically take that from our opponents, because our opponents weren't going to do free shipping in the first week. I was more than positive they weren't. Again, most of this game is competing with your opponents and trying to think of what they'll do or they will not do. And in this particular case, we were absolutely correct. So that worked out in our favor. So I don't mind with the free shipping that we don't offer that anymore. We make up for it now in SQ rating, advertising, and celebrity appeal. So basically, with the celebrity appeal, people don't mind paying extra money knowing that their favorite celebrity is endorsing my shoe. Looking at the wholesale segment, we got the same things, except now we have delivery time as a bonus and retailer support. However, our price kind of puts us out of the wholesale market a bit in terms of weaknesses, but the amount of strengths our company has makes it to where that price is not so bad. And I mean, if you look here, our average market share is still higher than all of our opponents. We own 17.3%. So we're doing something right there. Again, comparing our prices to our opponents, you can see that some of our opponents are taking some really risky extreme strategies. For example, this individual here, Company E, is selling their shoes really, really cheap. But online, their shoes are really, really high. Making it to where no one's buying their shoes. Like, I mean, their market share is 6.9. Whereas on the internet market, we've got a 30.9%. We actually could raise the prices a bit, because why not, honestly? Company E is also making some additional strange strategies. Basically, their quality of their shoe is terrible. I mean, an SQ rating of 3. The prices are incredibly high, and they're barely advertising for their shoe at all. I mean, there's a multitude of reasons why they're not succeeding, but ultimately, I don't really know what this person's going for with their strategy. Looking at the wholesale segment, the same problem arises. Retailer support is minimal. There's no advertising really, very minimal amounts of advertising. But the demand is still there for their shoes, surprisingly enough, and they actually increased in demand despite the low quality of their shoe. So I don't know. Maybe they are onto something, but just from what I'm looking at, I don't know if I feel like it's ultimately working out for them. Because I mean, we're still selling more shoes for the amount of cost that's not too much. But I don't know. Maybe they're onto something. Maybe they know something I don't. So anyway, taking a look at the performance chart. Well, yeah, see here we can go into more detail about performance charts. There's lots of stuff here really going into detail about how you're doing and if you compare it in a 3-year segment and so on. Ultimately, our investor expectations have been pretty low, and we are more than exceeding these expectations, and I'm very, very happy with how we've gone so far. I mean, just 2 years ago, we were only making $250 million. Now we're looking at $460 million in net revenues, and that doesn't even count what we're projecting. Our credit rating did go down, but again, it's higher than it ever was before. It was only at an A- in the beginning, and now it's at a solid A. Our image rating has also increased astronomically, going up 28 whole points in all that time. And global unit sales, we can see that basically, if we wanted to look, we were selling about 5,000 in unit sales. So that's, 5 million pairs of shoes? And now we're selling upwards of almost 10 million. We've almost doubled the amount of unit sales that we are actually shelling out there. Our internet, our wholesale sales, as you can see right here, private label sales, and the internet sales is the blue bar. You can see that our internet sales is actually making up a pretty good chunk. Whereas it was only 226, we brought it up to almost $800 in this case. So that's looking wonderful. Private label sales looking good. Everything's looking good. Really, the only market we're not striving to hold control of is the wholesale sales, which is, it's harder. That's the toughest one to compete in. But ultimately, going for the private label sales is earning us buku bucks. We've dominated that market. Honestly, we've increased our share there by almost 4 times, if not 4 times, over the past couple of years. And our global market share, as of year 12, we own 23% of the market. We own a quarter of the market. There's 7 companies competing, and we own a quarter of it. So we're doing a pretty damn good job, however we're doing it. And finally, let me go over, now that I'm done, kind of waving my dick around, let's actually take a look at what we're projecting for next year. Now, these numbers are much smaller than what we were looking at before. Revenues are not looking to double this year. Profit is still up considerably, plus 21.4%. And we're going to be ending with about $28 million, which next year is my plan to actually use to increase plant capacity and or pay off our debt. Something I did do this turn is I actually purchased additional capacity. 1,000 more capacity in a North American plant. At this point in time, we're producing 3 million, 2 million, 5 million, 9 million. We're producing, with overtime, over 10 million different pairs of shoes. This is going into private label sales. This is going into all sales. And we're ending these turns with barely any leftover shoes to worry about. I'm not having to add on additional shoes or worry about that crap and selling leftover stuff and getting penalties. We're getting rid of all of our shoes as we go. And we're making a crap ton of money while we do it. And I gotta fix that. Yeah, there we go. Fix it. This is 58 shoes less. Which market is the most filled up? Well, let's sell about 550. Let's say 550, and then we'll say about 120. We're selling just a couple bit less shoes. I got to make sure I fix these numbers. Otherwise, you're going to have incorrect data. So 264. All right, there we go. Okay, so that fixed a couple of our numbers there. They must have gotten mixed up at some point. So we could probably finagle with a couple of these numbers to bring down total cost a bit more, yet still maintain our high SQ ratings. Again, our SQ ratings are above and beyond in total quality, so I'm good with what we're doing. People like it. People like what we're putting out. And look at that. I can decrease the quality of the shoe significantly, and people are just like, nope, I'll still buy it. So, and then see those SQ ratings are still good. And we brought it down, gave us a bit more money, gave us a bit more revenue, so on and so forth. So yeah, we can sit there and mess around with these numbers for quite a bit. But ultimately, the important part to note here is indeed that we're looking at $8.77 a share. We're looking at a return on equity of about 28.1%, which is still a grand number as far as I'm concerned. An A+ credit rating, which is phenomenal. An image rating of 98, which is perfect. A net revenues of $510 million, $87 million in profit, and an ending cash on about $28 million. I'm good with these numbers. I'm perfectly good with all of them. And what my biggest concern right now is to pay off some of our loans, because if you look at how much we are generating in expenses on our loans, they need to be gotten rid of. Like point blank, we need to get rid of them now, because we're paying 35, roughly, let's round it up to 36 million, and then 18 million, so 54 million, plus an additional 12 million on top of that in interest. We're looking at a grand total of about $66 million we're paying a year in loans on interest and repayments and so on. So take that out of our total profit, which is we're estimating to be 87, roughly 88 million. Add that to it. So 88 million plus 66 million, and you're looking at what? 144 million, 150 something, roughly 150 million dollars in profit. That's redonkulous. Basically, if we're making $510 million in revenue and we're making 25 roughly percent of our company back in revenue, more than that, even 30%, I'm good with that. I'm totally good with that. Those are great numbers. So as far as I'm concerned, we just need to maintain the course, keep our prices roughly the same, remain competitive like we've been doing in the wholesale market, maybe even be a bit more aggressive on our pricing, because we have been very specific about it, and even allowing ourselves to take some freedom here or there because of the quality of our shoe, because of the celebrity appeal that we hold in these areas. But ultimately, I'm good with this. I'm good with all these numbers. I'm loving where everything is looking. The only concern I have is if our opponents decide to be far more aggressive in their pricing strategies, which could become a problem for us. If they decide to all lower their prices significantly lower, then we could be looking at far more scary numbers here. We could be looking at our opponents having much more dominating shares, which is definitely scary in itself. But we'll see. We'll see what happens. Again, this is still very early on, and who knows? Maybe they won't come up with these ideas, and they won't come up with these type strategies. I hope they don't. I hope they live in blissful ignorance, because ultimately that means I make more money, and that's what I'm shooting for here, is to be the most successful of my opponents. So we'll see. But anyway, this has been Commissar Bro. Thanks so much for watching, guys. I hope you've enjoyed this series thus far. It's going to keep getting better and better as we move along. So I'm really hoping that you guys are enjoying watching as much as I'm enjoying playing the game and seeing how things are progressing. Again, this is a really cool game, and it's just fun to mess around with the numbers and see what happens. So I don't know. It's going to be cool to see what happens next week. Anyway, this has been Commissar Bro, and I'll see you guys next time.